Welcome to the Investing Mastermind Podcast. I'm Marki.
And I'm Signe Lonholdt.
And today we're so excited to share with you our thoughts about Warren Buffett and Charlie Munger's 4 principles of investing that are critical to understand if you want to be able to invest like some of the best investors of all time.
Yeah, and the 4 principles, it could sound a little bit scary. Okay, it's the best investors. These principles must be really advanced, but don't worry, because they're not. It's really, really common sense that we're going to talk about today. So yay, it is not that complicated. How do we know about this, Michelle? How do we know the secret 4 principles to investing?
Well, as probably folks have heard us talk about earlier in this podcast, we both learned a lot about Warren Buffett and Charlie Munger from another podcast called Invested by Danielle Town and Phil Town. And that's where I first came to this notion of these 4 principles of investing like these guys and, really breaking it down in such a way that it makes sense of these 4 main areas to look for and have some understanding about so that you can feel comfortable about what you might be investing in. And a lot of this has especially to do with if you were interested in investing in individual stocks of companies. So it may have the most effect on that, like if you're interested particularly in stocks, but it could also relate to other areas like private businesses or any kind of potential investment endeavor that you might be getting involved in. It could help you build skills in that way too. And so, Signe, what do you think are the first principle we want to say to our audience today?
The first principle is really important because it is the first one. It's like step number 1, really. You shouldn't move on beyond this step before you're absolutely certain that you've got this one down. And this one is called, Warren Buffett calls it circle of competence. Those words might actually sound a little bit complicated, but it's really all about investing in something you know about. Could be a product or a service that you're raving about to your family and friends, something that you really, really love to use. What is the business behind that product or service is something that could be your first step to finding out more about this business. And you can simply do a Google search, look up the business company name, look it up on Google in order to actually find who is behind this product. Maybe you already know. What Michelle said is really key because there's a business behind the stock. It's not just a stock ticker. It's not just a price on a chart. And that's why it's so important to find out, okay, which business actually out there do I find super cool? And one way could be a product or service that you really love to use. That could be a way to find it.
And when you think about like things you use every day, like let's say every morning when you wake up, you got to have your coffee or tea. And so there are some popular companies that offer tea and coffee and breakfast foods and foods throughout the day. If you visit their cafe, let's say, and if that's something you're really passionate about and you appreciate the quality of that coffee, you might want to look into, is that restaurant or cafe business a publicly traded company? And if it is, that might be something you might be really interested in because you go to them every day through the drive-through and you get your morning coffee on your way to work, and you see a lot of other cars in the drive-through, and it shows that you're not the only one who really appreciates this coffee business. So sometimes that can also give you a really strong clue as to companies to look into.
Yeah, and you say something really key here, because what you said is it publicly traded? And again, as a new investor, you just need to Google search the company name, and public or stock could be a search word as well. And sometimes you find out that something you really love to use is not publicly traded, and that means you can't buy a stock in that company. There are many privately owned businesses out there, and these companies don't issue stocks for investors. You would have to buy that whole business, as Michelle also mentioned earlier, if you're interested in that company. But let's just stick to the stocks for now. But yeah, that's a really easy way of finding out if something is publicly traded or if it's a private business and you can't invest in it.
Right. And I
So
want to add to your point about, this is something you're capable of understanding. And when I mentioned the coffee business, I think most of us can probably understand, a beverage kind of company that makes a pretty simple product that I think a lot of us can understand. But sometimes you might like more complicated companies that maybe they're in aerospace defense or, something that is a more niche market where maybe you work in that industry and you are able to understand the ins and outs of a complicated business. But if you don't understand the ins and outs of a complicated business, sometimes it's better to just take a step back and maybe take your time to get to know an industry before you were to just go out and buy a stock. Because some famous investors like Peter Lynch have said that sometimes people take a lot of time getting to know a housing market. Like they really search homes in a certain neighborhood and check out the schools and check out the plumbing and the state of a house for months, and they really deeply learn about what it means to own a piece of real estate. But then people don't always take that same time to learn about companies and industries. So you have to try to really understand if a certain industry or a type of business is something that you can really understand, because sometimes they're way more complicated than you would expect. Like, say, a banking stock or an insurance company, even though we might bank at that certain bank, it doesn't mean that we know what's really going on and what's on the company's balance sheets, or, what's really going on that's behind the teller that we might see, or the ATM machine. There's way more to a bank than what might meet the eye. So that's just something that we should be mindful about.
Yeah, absolutely. And we'll dive much more into, we were actually talking about making an episode that's only about circle of competence and really diving deep into this topic. So we'll come back to it in a later podcast. We'll move on to the next step that you need to really be able to understand in order to proceed with these 4 steps. So step number 2, Michelle, talk a little bit about. It's also a very, very special word, in my opinion. I definitely had not heard that word before I started learning about Warren Buffett.
And that would be moat, right?
Absolutely. Yeah. Moat.
Yeah. So many of us,
for us foreigners, please do share, what is a moat?
well, there actually might be a bunch of moats in places like Europe surrounding castles. And if you think about the medieval times when you lived in castles, maybe you had a body of water surrounding the castle, and it was to protect you from enemies, right? Because if there were some other fiefdoms that wanted to take over your territory, they would need to find a way to either swim across the moat and climb your castle, or take down the bridge to get over into your castle. So in many ways, this idea of moat comes from those medieval times of, if you think about a business being like a castle, it's trying to protect itself from invaders, like other competitors, other companies that maybe want to take market share and want to take away your customers, and they're trying to infiltrate your economic castle. So the way that Buffett describes what a moat is that your business has some intrinsic, durable, competitive advantages. So let's say in the case of a castle, maybe it's a special kind of rock that's hard to climb up. And if you go with that analogy and compare it to a business, maybe a business has certain secrets or certain ways that they conduct business that's really hard for an invading company to crack that code and figure out, what makes your business special. And what else do you think we should add to this idea, Signe?
Well, yeah, something that's really important is that, at least, for us, we, it's our hard-earned money we're talking about here. So we want to make sure that our company is a winner. We want our company to win over all the competitors. And that's what the competitive advantage is going to show, is that this business is unique because they're winning. So I think that's for us, we don't want to gamble our hard-earned money. We want to make sure it's a winner. And for a beginner investor, this concept can be a little bit difficult to grasp. And again, we're going to dive much more deeper into moats in a later episode and really share with you what type of moats are out there. But it's really about training your mind as a new investor into thinking, what is this company's competitive advantage? Because Warren Buffett, we're so lucky that he has given different categories that we should be looking for. And one of the companies that we talked about, Michelle, was a business that has a really, really strong switching mode, is what it's called. So it's really, really difficult for people to move away from using that product and then start using another product. It'll take a long time for me on my phone to have to start up with a new type of operating system. That would take me a long time and money to build up my, the same kind of tool that I have in one phone versus the other one. So that's, switching cost is a really great competitive advantage, because next time I'll probably buy a phone with the same operating system.
Right. And to your point, there's only basically a duopoly of phones that you could choose from. You have two main options that you can basically go with. So I'm sure many of you already know which are the two main operating systems in phones, and they would be Apple and Android primarily, that most people have the choice of choosing from. So based on that, you have a lot of effort to switch between them if you no longer like one type of phone operating system. But let's say you've been using it for many years, it could take a while and take some time to develop comfort in knowing how to navigate around another operating system in your phone. So
yeah.
yeah.
And to that point, switching from iOS, which is Apple's operating system, over to the Android system is, you can't just do that. You can't just say, okay, I'm going to bring everything with me. No, you have to pretty much start from scratch in terms of setting up your phones and your apps and all the resources that you have on this tool. In order to navigate this mode, I use a checklist, which is also a topic that we can dive into in a later episode. But you already hear us starting on the checklist, like step number 1, it needs to have some meaning. Step number 2, it needs a moat. So you want to make sure that check, yes, I do understand the business. Check, yes, it does have a strong moat. It's a winner. So that's a concept that I really like, that I know Charlie Munger is using. And I don't want to trail off too much here into talking about checklists, because I do believe it's a great other topic for another episode, but think a little bit more about that concept as a new beginner for sure. Moving on to the next step is management. And Michelle, what do you look for in some good management? And we talk about management. We do talk about, for example, the chief executive officer, which is CEO, which is one of the key people, as well as some other important people. But what is something that you look for in management?
Yeah, absolutely. And one thing I learned from Charlie Munger is that we want to look for management that has integrity and talent. And what integrity means is that what someone says and what their actions are synced, that what you're saying to the public in your shareholder letters or in conferences or at any public scenario where a CEO is communicating with the world, that they can actually carry through in real life what they set out to do. So if they have super big goals, did they actually come true? Or if they didn't work out, did the CEO just sweep them under the rug and pretend like they never said it? So you want to look for if they're being true to you and also the shareholders, because, you as a prospective shareholder, you want to try to see for a consistency in character of, is this person really being honest with not just shareholders, but also all the stakeholders involved, because there are employees and communities that could be affected by the actions of a company. So you want to look for a conscientious CEO that cares and is actually being full of candor. And what candor means is that you can discern that there's an honest quality to how they are communicating with the world, that it's actually believable and you feel like they are being honest with you. So those are just some things to look for in terms of integrity. And then with talent, ideally you want a CEO that seems like they know what they're doing and that they're making the right decisions as far as how they're allocating resources, including the company's capital toward projects, and if you think that they're making the right moves. And it might be a few ways that you can tell if a CEO has talent, and one way might be a qualitative way, like the impression that you get and the all the objectives that a company is putting out there. Does that seem like it makes sense in terms of if you're analyzing those qualitative aspects of a business? And then also quantitative, there are some financial metrics that you can keep track of, one of which is return on invested capital, that we'll get into at another time. But that's one quantitative metric among many that you could check for in a CEO. So I just wanted to mention those 2 points about integrity and talent. And Signe, would you like to also say something about what you look for in management?
Yeah, well, it's of course the same things. These great qualities. Warren Buffett, he says he looks for integrity, intelligence, and energy, and you definitely want to make sure that they have integrity, because if they have a lot of intelligence and energy, it can go really bad. So yeah, it's sort of the same thing as Munger says. For me, management is really one of my favorite things because it is kind of interesting to study people. And when you find a great CEO, a great management team that works for the long-term growth of the business, it's really amazing to follow and kind of interesting. So this is actually one of my favorite things to do, listening to, there's these calls, it's called earnings calls, where management talk about the performance of the business. You can go follow them on LinkedIn, etc. There's, again, this is a whole topic that we can discuss in much more detail. It is kind of fun to keep track of management, maybe follow them on social media and things, and see what's actually going on. And some of the great managers out there are super interesting to follow. So yeah,
Yeah.
That's definitely one of my favorite things to do within this discipline of investing.
Right. And there's such great role models out there too, like people who you would like to model your own career after.
Absolutely.
And they can also, share lessons with us that hopefully we might not make similar mistakes if we were in their shoes. And that's one way that a CEO might exhibit candor, is if they're willing to admit to their mistakes, like Warren Buffett has. And it takes a lot for a CEO to admit that and be comfortable in their own skin, that they're secure enough with who they are that they're willing to tell you when they messed up. So I think that speaks volumes in terms of if you find a CEO believable.
Yeah, and I really like what you're saying about role models. I 100% agree. And, it is something that we will talk much more about in a later episode, is actually how you can see, you can learn from your own career about management and these amazing role models, where we'll, share a few of our management role models and a cliffhanger for that could definitely also be a question that you asked at a Berkshire Hathaway meeting to a management team that was there and giving a presentation. That would actually be a fun story, maybe, Michelle, to share also in a later episode. So keep tuned in order to hear that amazing story from our trip to Omaha. So moving on to the next and last step before we still haven't invested, right? We haven't bought the stock yet. We're still looking into this company, but we're getting closer to buying with this new step, right?
Yep. And the last one is known as margin of safety. And that might not be a term that's in everyone's minds right away, unless you're an engineer. Like if you were an engineering major, maybe in college, and you're working as an engineer, you might already know this, because when things are built like bridges or anything in infrastructure, they're typically built with something called a margin of safety. So if you notice, like you're driving across a bridge, it will say the limit of how many tons are allowed to cross that bridge. And that's the maximum limit. And most trucks are not nearly as heavy as that maximum limit, but that's building in a margin of safety as to, let's say the trucks are half the weight of the maximum that the bridge can hold from just one vehicle. That's known as a margin of safety.
But how does that relate to investing? It's like, that's I actually, yeah, I didn't know that about engineering, so that's super cool.
Yeah, and so if you take that concept and apply it to investing, what that's suggesting is you have to come up with a way to value a company, and we'll talk way more about how to value a company. But let's say that you determine a company is worth a certain amount of value, and what a margin of safety means is that you don't want to just buy it at the current value that you think is available in the market. Let's say a company's market cap is like $700 billion, and you think, okay, that's the full price. That is the maximum value of the company right now. But ideally, if you could buy that company at a discount to $700 billion, let's say at $350 billion, which is 50% off, then maybe you're buying it with a margin of safety, that you are buying it at such a low price that you're okay with if you might be a little bit wrong, but you won't be too wrong eventually, because you gave yourself this margin of error that in case, the company might not really be worth that amount of market capitalization, but it could be worth somewhere in between what you bought it at and then what you think the maximum value is. So I hope that makes sense and isn't, too much of a complicated idea to wrap your head around.
Yeah, it is a little bit complicated with some of these words. We're maybe imagine that you're buying a coffee shop on the corner on your little street in your town. Before you bought that company, you would want to know, what is this actually worth? If I had to buy the whole company today, what is it worth? Now we're talking about stocks. So we break that cost into several portions. We don't have to buy the whole company. We can buy a portion of it, but we actually want to just figure out, what is this worth? And though it does sound difficult, there are ways that makes it much easier to actually evaluate. And there's a lot of tools out there that's there to help you. But we really want to find the value of the business. And then, as Michelle says, we want to buy it at a discount. So where some people, when they buy a business, they are so eager to buy that coffee shop that they want to pay full price and maybe even more in order to get in. For us, we want it at a really, really great price, because that is sort of the essence of the value investing discipline, is buying the stock at a lower price than what that business is actually worth, buying it at a margin of safety. Because if we made an error in our calculation, we were still good. Or if we made an error when we tried to figure out the moat, or with management, they didn't have integrity and talent, we bought it. So we have that margin for errors. Do you have anything more to add to this? It's a little bit difficult, but again, like you said, Michelle, we'll dig much more deeper into that topic and actually help you out on how to calculate the intrinsic value of a company.
Yeah, and maybe a more simplistic idea of the way to think about margin of safety is, let's say you're buying just a house, and let's say that house could be valued somewhere between $100,000 to $150,000, and ideally you want to be able to get a good return out of it if you're going to rent it out. So let's say getting a 10% return is acceptable out of that house. And so if you're able to buy the house closer to $100,000 so that you can perfectly get 10% out, which means you're getting $10,000 out of that house every year in rent, that would be ideal. Whereas if you buy it closer to $150,000, you're only going to get 6.7% out of that house in the year. So only $6,700 comparatively, because you paid too much maybe for that house. So if you pay a lower amount, that means you're getting a margin of safety that if there's other things that go wrong, like maybe you have to get a new roof for the house or put in more maintenance than you expected, but you bought the house at such a low price that you can still get an acceptable amount of rent out of it, like closer to an acceptable 10% out of it, instead of the less ideal 6 or 7% if you paid a higher price. So I hope that little example of buying a house that you're trying to rent out can also reinforce what we're talking about in terms of margin of safety.
Yeah, and in a later episode, we'll zoom back in on this topic and also talk about when you actually can buy at a margin of safety, because that's probably one of your questions right now is, yeah, that's great, but when can we ever buy anything at a discount in the business world? So we'll come back to that later. So we've been through the 4 steps now, the 4 principles of value investing. It is circle of competence. It is the moat, management, and margin of safety. And once you've been through all of these 4 steps, you know, you're ready to invest. If you came through all of the 4 steps, now it's actually a time where you could buy the stock because you've now found yourself a truly wonderful winner, a wonderful business that's wonderful in their industry. And if the price is fair, you're ready to invest in it, right? It's the
absolutely.
good part.
Yeah. If you did your homework, you thoroughly research the company and you feel like you understand it and you believe in it and you find that it's available at a price that makes sense, you know, it's like, why not go for it, you know? And that's wonderful. That's what Warren Buffett calls stepping over a 6-inch bar. That's what you want to find. You don't want to have to jump over a 6-foot bar because that's just hard, you know? So absolutely.
Yeah. And if you do these 4 steps, you're going to do more than 98% of other individual investors or non-professionals out there, because a lot of people, what they do is they look at the price chart and that's how they invest in a stock, or they hear it from their neighbor or in a radio show or something like that. And then they jump into the stock, and then maybe later they found out, ooh, this wasn't a great, you know, stock. Here we just flip it around. We do some research to begin with, and then we're ready to buy, but we're also ready to hold this for a very, very long time. So all of this work that went into finding these 4 principles are going to pay off, because we just have to sit and wait and just look at the stock price going up, right? Because we bought
hopefully,
it
or
at a great price.
it might go down for a little bit immediately,
That's
but
true.
if you've done your homework and you have conviction in it, and it doesn't scare you as much, because the part where a lot of us investors, and I've fallen into this mistake myself, is that before, you know, I would just look at, say, is this company giving dividends, and does it look like it's kind of going up in the stock chart? And then if I just bought it, but I knew nothing about the stock, I'd be worried, like, oh, it's down 5%. Like, am I going to lose my money? Or if it's down even more, like, you're in agony because you just don't know anything about it. So
Yeah, and here you do know a lot about the business, so you understand it better,
yeah,
what's actually happening.
yeah. So you can have that reassurance that, you tried your best to understand. And even though we can't always know everything there is to know because we might not be on the inside of the business. So sometimes, that's all we can do. But, you do the best you can. And, if you follow these principles, you will have more likelihood of success than otherwise. So, yeah.
Absolutely. All right, but we're coming to an end of today's show. I hope you enjoyed the show. We're back on Tuesday, so I hope you'll join us again next Tuesday. See you until then.
All right.
Bye-bye.
Bye.
If you enjoyed the show and found the content informational, we would be super grateful if you would leave us a review and follow us wherever you get your podcasts so you automatically get new episodes in your feed. We publish a new show every Tuesday.
The contents of the Investing Mastermind podcast are for educational, informational, and entertainment purposes only. None of this is investing advice. And if you need help in your personal situation, please consult with a professional.